Are you ready for a currency collapse? A lot of people say that it can't happen in the US, that hyperinflation cannot happen in the US. I wanted to share this article from Jim Rickards entitled "It Can't Happen Here." We'll go through it. I will put a link in the description below. So let's have a look. The Federal Reserve printed $4 trillion in the years following the 2008 crash, expanding its pre-crisis balance sheet of about $900 billion to roughly $4.5 trillion. Many people thought if hyperinflation were ever going to happen in the US, it would have already happened. Well, it never happened. Today, in response to the pandemic and the economic lockdowns that followed, the Fed has cranked up the printing press to even higher levels. It's printed almost as much money, or currency, in 1 year as it printed in the several years after the financial crisis. On February 26, 2020, the balance sheet was $4.16 trillion. Less than 1 year later, it's roughly $7.3 trillion. Meanwhile, Americans' M1 currency supply spiked 70% last year. But this blizzard of currency printing has not caused the level of alarm that the post-financial crisis currency creation caused. If we didn't get hyperinflation then, they say, why should we get it now? Most people are complacent. They have a point. We still have no hyperinflation or even moderate inflation, except maybe in asset prices. But I've even argued that we won't see inflation right away. Inflation is not only a product of money creation, but it's also of money velocity. Now, I don't want to say that Jim Rickards is wrong, and I don't want to dismiss velocity as an important part or a part of the whole inflation story. However, I just want to pull a few things out. Now, these graphs that I'm about to go through come from Lynn Alden, so I thank Lynn for these graphs and her work. But what I want to point out here is a couple of things. So one, we've got the M2 velocity in blue and the annual inflation rate in orange. Now, back during World War II, you can see here that we had high inflation with a brief velocity spike. So maybe you could argue that velocity plays a part in inflation. However, if we fast forward to the 70s, we can see that we had high inflation. Everyone knows that we had high inflation during the 70s. However, we had weak velocity back then. We had weak velocity. And then fast forward to the 90s, we have a rise in velocity. In fact, multi-decade high rise in velocity, but we had no inflation. When we have a look at the M2 per capita growth and the annual inflation, we see probably a much better correlation. In fact, the M2 per capita growth tends to lead the annual inflation. And as you see, obviously in 2020, the M2 per capita growth is absolutely skyrocketing in levels not seen since World War II. And so the question is, what happens to that annual inflation rate? Does that follow, like it's done in the past, the M2 per capita growth? And this is where I think Jim is arguing that, yes, once the economy opens back up, and Jim Rogers says this as well, Jim Rogers, so two Jims argue this, that when the economy does open back up, all these new currency units are going to be starting to move out there into the economy, buying goods and services. Now, where I say that, they're right, but also kind of wrong, and my thesis for inflation or stagflation decade is what this recession, depression, virus, whatever you want to call it, has done to the economy is we're seeing small businesses, small and medium enterprises going under. We're seeing less goods and services being produced, and that's going to play out as we move forward. That we're going to have less production because there's less businesses. And with all these new currency units, once the economy really does open up again, you're going to have less production, less goods and services, and a lot more currency units chasing those goods and services. And that's pretty much the Austrian understanding of inflation. is that expanding the credit and currency supply. If the production doesn't increase to match that, then you're going to get inflation. So even if production does increase or stays the same, if you just increase credit currency supply, you're going to get that inflation. So if we overlap all that, we have a look at the M2 velocity, the M2 per capita, and the CPI inflation. Once again, back in World War II, we had a money supply growth or a currency supply growth, brief velocity spike, but high inflation. In the 70s, we had that currency supply growth, which was, fairly high there, which you can see. But we had weak velocity, but we had high inflation. And in the 90s, we had weak currency supply growth, a sustained rise in velocity, as I said, multi-decade high in velocity, yet we had low inflation. So look, what I recommend doing is check out my video, Inflation Explained, from Ludwig von Mises. I'll put a link in the description below. And then check out my video once you've done that and you understand the true definition of inflation, because what you hear out there with so-called experts really have no idea. And then check out my video, The Cure for Inflation. And these are obviously my opinions, but they come from an Austrian economic perspective. One last slide that also is part of my thesis. So there's this whole debate that QE is not inflationary. In fact, it's deflationary. And that, we haven't seen inflation, and this has actually motivated the MMTs to go, we can print as much as we like. There's no inflation. However, the difference is the QEs that we've had since the GFC have basically been, yes, they're bank reserves. They are held at the Fed, and then the banks lend that out into new currency. However, back then, as you can see from this graph, and once again, I thank Lynn Alden for this, you can see the QE in red, fiscal spending in green, and deposits at commercial banks in blue. Now, when we had all those QEs, yep, QE went up, but that stays in the banking system. That stays at the Fed, and then it's up to the banks to lend that out, right? But we never saw an increase in deposits at the commercial banks. So QE wasn't getting out into the real economy, into household and business back pockets. However, have a look now, where you've got to throw in the QE, you've got to throw in the government transfer payments, the deficit spending that the government is doing. And with the Biden administration, in fact, all around the world now, we're going to see continued government deficits, MMT, universal basic income, you name it. It's going to be governments are going to put payments directly into household and businesses' pockets. And yes, it's going to come through via central banks doing QE, because even though they don't buy it directly, now I think we're going to see that perhaps change under this current administration. But what they do is the commercial banks or the dealer banks use that QE, use those bank reserves sitting at the Fed or sitting at the central bank, whichever country you're in, and they can use those to buy those government bonds. And so basically, they're just really a middleman. So ultimately, the end scenario, the end result is that the central bank creates new currency units which go directly to the the government's treasury account, which then go out into the real economy. But you've got the dealer banks right there in the middle, just acting as a middleman. So, but what we're saying is, with the government now involved in this process, so the banks weren't lending it out, so the government are now spending it out, is we're seeing a massive increase in deposits in commercial banks. And so, yes, the two gyms will be right that when the economy does open up, all these deposits are going to start going out there, going to work. And however, because of the damage to the economy, there's less production. There's going to be less and less production. We're also going to, globalization's peaked. Every economic theory says that globalization was deflationary. So if we're going back to onshore, if we're moving away and embracing that deglobalization, then that's got to be inflationary as well. So that's my thesis. I don't see governments allowing the free market to work and to collapse and have all this debt be destroyed. They're going to go into overdrive and MMT, universal basic income. There's going to be transfer payments from government being funded by central banks, going straight into households' pockets. And so, anyway, that's my thesis. So we'll see what happens there. So back to the article where we left off. You can print as much money as you want, but if it's not exchanging hands and there isn't much turnover, it won't lead to inflation. Inflation is at least as much a psychological phenomenon as monetary phenomenon. And expectations right now are for disinflation. Because of the lockdowns and the economic fallout, we'll likely suffer a recession in the first quarter of 2021. Money velocity is low, so disinflation is a problem in the short term. But that doesn't mean inflation isn't coming back, or even that hyperinflation isn't possible once it does. Inflation will return, and when it does, it would be massive and potentially lead to hyperinflation. All this can happen faster than most people think. When you hear hyperinflation, you might only think of two images. One is a reckless third world country like Zimbabwe or Argentina printing money to cover government expenses and worker salaries to the point where trillions of local dollars or pesos are needed to buy a loaf of bread. The second image is of the same phenomenon in an advanced country such as Germany, but long ago. Perhaps you think of grainy black and white photos from the 1920s displaying people carting around wheelbarrows of paper money. The last thing you probably think of is hyperinflation in the 21st century developed economies such as the United States. We tell ourselves that hyperinflation might happen in far away or long ago places, but it can't happen here. Yet it can happen here. In fact, the United States flirted with hyperinflation in the 1970s, or the late 1970s, when treasury bonds were denominated in Swiss francs because the dollar was rapidly depreciating and people were losing faith in the dollar. We also flirted with hyperinflation in the late 1910s. Other episodes arose after the Civil War and the American Revolution. Hyperinflation acts like a deadly virus with no cure, may be contained for long periods of time, but once it breaks out into a general population, there may be no stopping it without enormous losses. To explain why, it's essential to know what hyperinflation is, how it begins, and how it feeds on itself. In a complex system such as the US economy, small initial blunders can have catastrophic consequences once feedback loops and behavioral changes take over. Just an update on the silver market. I saw this chart on FinTwit, thought I'd share it. So we've got the physical, the Sprott Physical Silver Trust, which has outperformed both the SLV ETF, the silver spot, and the silver futures price by about 4% over the last 4 days. And with JP Morgan being the custodian of SLV, some people say it's not really a silver squeeze, but a JP Morgan squeeze. Look, I for one don't believe that SLV have the 750 million ounces to back the number of SLV shares out there. Now, what's interesting is some people are telling me that be careful of the leasing arrangements in physical gold and silver, that some people are leasing product from different mints, different vaults, and claiming that they've got that they own it, that it's on their books, that it's on their balance sheet, when in fact they're just leasing it and they don't really have it at all. So there's a lot of weird stuff happening in the silver market at the moment. In 2020, we saw a 700% rise in coin sales for gold from the US Mint, and a significant rise as well in silver. However, in 2021, as my thesis continues to play out, I believe that more and more people are going to, and we're already seeing it. Yes, you could say that it's all hyped up with the silver squeeze stuff, but we've already seen it, that silver coin sales have gone up significantly. And I do expect sometime in 2021 for it to hit those levels back in 2011. And we are seeing a two-market system happening between the paper market and the physical market. On the left is from Brisbane Bullion, where they had sold out of their 1 ounce Kookaburra silver coins. And what's interesting is just a week ago, I bought them for a week ago, maybe just over a week ago, 2 weeks ago, I bought some coins for $38. And you see they jumped up to $46. They've now got some stock, I've been told, as of yesterday, and the price of that has come back down to about $45. But also APMEX here on the right, look at the price, $38. So obviously the $46, that's in Australian dollar numbers. Now our Aussie dollar's around 76 cents. So obviously priced in Aussie dollars, gold and silver is going to be higher. But what's funny is on the right, we've got, US Mint silver coin products there for $38, where the silver price is around $26. The paper market is around $26. Yet to buy the physical coin in the US is going to cost you $38. And here in Australia, it's going to cost you $46, where the Australian paper price is about $35. So there's a significant premium on the physical, and that's not just the dealers trying to profiteer out of this. There's a lot of costs that get added on along the way, and look, some of the prices do go up to try to slow demand as well along that way. So anyway, what do you guys think? Love to see your opinions in the comments below. And if you like this video, please hit the like button. I really, really appreciate it. It helps the algorithms, apparently. I don't know. That's what I'm told. I'm no tech expert or online expert. So, yep. Thanks, guys, for tuning in. And I'll see you again on another episode of Finance Uncut.